I know you spoke a lot about being a spy and getting to know the people behind the company. Maybe you could speak about which relevant financial metrics you find most promising to look at. Thanks.
Okay. It's a good question, because it's cost of finance and how do you evaluate things. The first thing to know what relevant financial metrics are two things. First, to know what things you don't bother with, because it's not worth your time. And the second thing is that sometimes you miss good stuff, but it doesn't matter. Microsoft, for example, for the last 4 or 5 years, 6 years, we don't care. The company is selling for about 7 or 8 times sales. 8 times sales mean that if you fire everybody in the company and you close everything down and you burn all the buildings down and you still get the revenue, you get your money back in 8 years from revenues, let alone legal obligation or the rest of it. I wouldn't even touch it. Yeah, margin at 90%, 95%, but there's justification. We don't do high price to revenue stocks. We don't do stocks that have huge debt. We don't do stocks in which the people in the company have criminal backgrounds, and there are quite a number. We don't do this, we don't do that. Once you eliminate what you don't do, it is easier to know what you do want to do. And saying that, you can still miss the Dells on the way up and Microsoft on the way up, but then you are a growth investor, not a value investor. So the metrics are, first of all, what are the no metrics? The one you don't want to do. The yes metrics are almost the opposite. We like the companies that are extremely cheap. We want to buy a lot of revenue, a lot of investments, a lot of EBITDA, a lot of this, a lot of existing that, everything, for very, very little. You want to buy $100 million of revenue for 20, unless it's a supermarket, because then they have almost no margins, rather than buying 20 for 100. Saying that, you buy the 100 for 20, they may go bust, and you buy 20 for 100, may be a good deal. But you want to buy things cheaply as possible. And this means that the investment decision is a rare decision. You have to accustom yourself with the idea you don't have a portfolio, you have investments. And sometimes you go for 6 months without an investment, maybe 3 months without doing anything. It's like dating. You don't have to date every night. Date once a week, make it meaningful. The investment idea is, I see that I'm kind of coming close to the borderline, but I'm non-PC occasionally, and you have to excuse me. It's all done with a good intention. The investment decision is a rare decision, and you have to be willing to miss a lot. So you buy things extremely cheaply, or at least that's what we try to do. And once you say extremely cheaply, then you can define as well as I do. You want to buy it for less than half book. You want to buy it for 20, 30, 40% revenue. You want to buy it for 3 times EBITDA. When was it? About 9 years ago? No, 7 years ago, year after we started. Some of our screens picked up a company which is non-tech, not really tech, and they were trading for 0.9 times EBITDA, less than 1 times EBITDA. This was the telecom company in Argentina. TEO is the symbol, TEO. And we said, it can't be, where the country was going broke. But it's a country, it will continue, you need telecom, and eventually the government will mush some paper and they will get some Brady bonds or something. And the stock went from $1 to about 15, 20, who remembers? Another company in Argentina, the TAR, the telephone company. One was the first was the utility, the electric utility, the other was the telephone company. I mean, if you decide you only want to buy the extraordinarily cheap, the first question you have to ask is, what am I missing? Why isn't everybody buying it? It's so deadly cheap. If that's what you want to do, you are going to be buying very infrequently, but you'll have a higher chance of success. You'll have to live with the idea that you miss a lot of good stuff. That's okay. Don't lose money. Does this answer the question? I mean, or you look for more specific. I mean, you want to buy half net plant and equipment. You want to buy half book, 20% of revenue, half working capital. I mean, invent. There's all the metrics, and you just want to buy very cheaply. And sometimes there's nothing to buy, so you buy nothing. You go read books, or write them.
Then how do you make sure you're not falling into a value trap?
That's a very good question. That's a very good question. The value trap is when you buy a business cheaply that deserves to be cheap. We had one like that about 1.5 years ago. InFocus, a company that makes projectors. Stayed the same price for years and years. We got rid of it because the business wasn't strong. If the customer is nice to have the product, but it's not crucial for them to have it. The question, what's a good business, is a deep question. It's a customer that is worth serving, who will answer fast, who will pay a lot. You can't really compete with the company. I mean, all the rest of the definition that you can find any place. But it's a good question. You want to buy a good business at very cheap prices. There are those who say you want to buy a superior business for fair prices, or buy a fair business for extremely cheap prices. We want to buy superior businesses for extremely cheap prices. So sometimes we have 90% cash. But it's how you kind of tweak the knobs on your machinery. Does this answer? No. Okay.
So you mentioned 20% in terms of the last 8 years. That includes the tech bubble and the crash. I guess, what was your kind of investment policy, and what were you looking at for your portfolio during the tech bubble, given obviously value or?
Well, it may sound flip, but it isn't. Our policy was to try not to lose money. Because our clients are extremely high net worth individuals, foundations. They are private clients. They are good clients in the sense that they answer fast. They are principals. We don't serve pension funds or any big board organizations who do things slowly. So for them, they already are wealthy. They want to become wealthier. They don't want to become poorer. So we want to buy things only if they are cheap and they are good and we can buy them. If you don't find anything, we don't buy. So when we got this sort of 18% in Canadian fund and 21% in the foreign funds, it was done with, I would guess, maybe 20% or 50% average cash over the years. The idea was not to lose money and to buy only the really, really cheap ones, and we didn't short much, which in retrospect may have been a mistake for 1 or 2 years. So we only buy the ones that really are almost look you in the face, that are obvious to buy. Beyond that, we have some metrics which I wouldn't go into because they're proprietary, but they're not very deep or secret. They're sort of obvious. Some are less so because we know technology inside out, and we know what really is sort of significantly important for them. But aside from that, the idea was not to lose money, to buy a lot of the good stuff that is available when it is cheap, and if it's not to be too sorry to miss it. And it's still working okay. Right now, by the way, we have a little bit more cash than usual because we just had 3 takeovers of 3 companies of ours, and bang, 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 so we haven't yet found things to put it into. Do you think for more specific, do you want some more specific answer? Because that's what, it's nothing more specific than that.
I guess if the highest cash position you ever had, was it at that time?
The highest cash was in September 2000, was 100% cash. Because we ran average accounts for a lot of accounts for the first 2 years, then we get more and more people coming to us. And so we said, what do? We rolled everything into cash. We said, it's crazy out there. And then we rolled into an LP, a limited partnership. But there was nothing to buy. So we had like about 100% cash. And the only time we had 5% cash, we never had fully invested, was in Q1 '03. We wrote to clients, a melt up is coming. I mean, we talked to companies and we saw what was happening and nobody cared. I mean, a lot of, shall we say, secretaries of CEOs said things to us that were totally opposed to what analysts said to us. And we trust the secretaries more. And stockroom boys and girls and people who are on the loading docks, they know everything. I mean, you have people out there who make 30, 40 grand a year. And with this, they put kids to school and buy the wife or the husband things to wear. And they save some money to go to the bar. And they really know they know how to manage the money. And they don't have any sort of fat bank account to fall back on. They really want to know what's happening. So they're asking, again, Gladys in purchasing, how much orders are coming in. If you talk to these people out there, they know. For them, it's here. And some of them know only about narrow areas. So in '03, we went like almost completely invested, but we left a little bit. But beyond that, there's going to be a time in which we'll be fully invested. We have been almost fully invested for a while, like about 10% cash in after September 11. I mean, if you see on our website, it's now there's a password on it because the SEC made us put one there. It is odd, but 3 weeks before the September 11, we wrote about valuation under bombardment. We gave an example of a friend of ours that bought an apartment in Beirut in August '82. It was the best time to buy. And 3 weeks later, I mean, spookily, we had September 11, but those things happen. But again, the policy was, but again, to be more specific, the policy was never to have more than about 5 or 6% of the stock, each stock at cost when we buy it. So we don't want to have like 5 stock, 20% each, too risky. We are allowed up to 10% in each position, so no more than 5 or 6%. When you start growing, it goes to 10, 11, 12% of the portfolio to start peeling back some, sell some to the market. If something goes below a certain amount, you sell it. Something over the years we learned is that if all of a sudden the volume of trading in the stock goes up by about 2 or 3 times, watch it. We had this year alone 2 day traders raids on our stock. I mean, we hold the stock for 3 years. Wonderful value. 250, 240, 240, 250, 260, 240. I mean, we are waiting. One day come to the office, 3 times the float traded, the stock is 7. It's worth maybe 6. If they know more than we do, I think it's public service to give it to them. Bang, the stock goes. No. This is not policy. It's common sense. Things like that. It is fun, infrequently, but other than that, you go out and you schmooze. Yes?
I guess one of the things you mentioned with Mosaic is that there wasn't a market value for the IP. In terms of technically that being their primary asset, how do you go about valuing them when there isn't a market value? And then secondly, I guess, with the private equity boom of companies doing LBOs on tech companies that really didn't happen before, what are your thoughts on that? Do you think that's going to persist?
That's two good questions. Let me take them one by one. How do you value IP? How do you value anyone here by way of earning potential? To value IP by itself without knowing the constellation around it is a risky game because you're playing venture capital. You're trying to see how good this thing will do in the future. It's what I call the invisible spreadsheet method. You assume the market will be $1 billion, you assume 10% market share, you assume 6% margins, you assume 5% discount, you have value. What happens in the case of Mosaic was that they went into a battle in a field whose parameters we know. Judges are indexers. Judges don't want to make a decision because the judge is a civil servant. If he or she is making a decision, it can be overthrown on appeal, then his name or her name is slightly mud. So a judge will decide on what he has to do. Other than that, he will push the litigants to settle with every ounce of power in his being. So a court system is one that's designed to grind the litigants until the litigants just settle. Everything is geared toward that. If you know that, then you know that the question before the court is not how much is the patent worth, but how can we get these guys out of this court. In the case of Mosaic, there are 2 questions. One is how much are the patents worth? And second, do they own the patents? The question is how much the patent worth was marked to market, already decided by the market, because they got about $300 million, about $290, from previous people, like Sony and others, who said, yeah, that's what we pay because that's what we think it's worth. The judge can put that before the jury and say the market already decided that's the stock price. It's like pricing our stock day by day. It's not our opinion. The market, there was a bid and ask, and the market cleared. So in the case of Mosaic, the value of the IP was one that the market determined. And therefore, the judge only had to say, is the patent valid or not? That's a question not easy to decide, but it's an easy one to grasp. The moment Samsung destroyed email, which we learned through a friend of a friend, the moment they destroyed email, Mosaic could have put them all in jail. They destroyed email because he was the nephew of somebody in Korea and he was trying to show himself bigger than his brother. Long story. And at that moment, Mosaic had a nuclear weapon. But it's a nuclear weapon they will never be allowed to use because any sane judge would never let the case go nuclear, go criminal. So at this point, you know a settlement is coming. At a certain point, the lawyer will bring Mosaic to court and Mosaic will say, we don't care what you say. We are going to go criminal. And the judge will tell the lawyer, control your client, because the function of the lawyer is to control his client. We'll never tell you that. But in a real case, the function of the judge is to get them out of the court. The function of the lawyer is to control the client and get it out. Otherwise, he's wasting capital he has with the judge. This is stuff nobody will ever tell you. It's unprintable. I mean, I didn't say it, right? I'm saying hypothetically. So the moment you know that, and the moment you know that the Samsung case is going to be settled, the question is how fast, how soon, how much, and so on. If you know how the system works, you don't have to know how to value IP. So in the case of Mosaic, the answer to your question is you didn't have to. In other cases, it's more complicated, much more complicated. You have to go into the patent law, you have to talk to people, and then you give a wider discount. Just today, I sold the stock TVL, the one that the V-chip was bought by Wyland. And we owned it for a little while because I thought the IP was worth substantially more. The people who run it are professors, they have no idea about marketing, and they don't claim to have any. And they were taken out, we had like about 40% gain in a short time because we knew what IP was worth. Just before I came, like last 15 minutes, I was selling the stock. So on this one, the valuation was more difficult. We gave a bit more leeway. But to value IP is difficult, and it's not the best way to make money. To create IP, you can make money. So if you want to make money in the market by buying cheap IPs and taking the value out of it, you want to be a Mosaic, you have to be a lawyer, a poker player, a diplomat, sort of a field operative. You have to be a James Baker, so to speak. Kind of a, as they used to call him the velvet hammer. You have to know how to really go head to head, but nicely. You don't make as much money as people in RIM did because they created the IP. And then the value, whatever the market determines. Does this answer the question? Or, yeah.
And then the second part about the way Silicon Valley in terms of private equity's interest in tech and doing LBOs, what do you think of them raising all the debt on assets that really aren't financial?
Anybody who the old British saying is, he who borrows what isn't his will give it back or go to prison. If you borrow money, you borrow stock, you borrow anything, you have to give it back. Or Jim Grant, a more recent guy, said, money borrowed is always returned, either by the borrower or by the lender. The LBO craze went bust, the private equity craze will go bust. Slowly with a whimper or quickly with a bust, I don't know. There's no need to lever. If you borrow money, it means you ran out of ideas to buy something to give you a high return, and therefore you have to borrow a lot of money to make your 2% return into 15. This by itself means that you are exchanging real work, what we call the sleuthing work, for financial risk and leverage. There's another factor operating there. If you have a commitment for $1 billion of private equity or LBOs, you don't get paid much. The moment this money is committed, you get paid usually 2.5% plus the 20. So the moment you commit it, on the $1 billion, there's 25 million bucks collected by the partners, and if it goes bust, it's the customer who suffer, in most cases. It's almost like Chase Manhattan Bank having loaned 50 billions to Mexico, and the people who have been the MBAs on the loan committee, they made their bonus, but then 2 years they buggered off and they went to JP Morgan, and the bank got stuck with the bad loans. So private equity, for me, is nothing more or little more than levered investment. Plus, if you do it in a company which is fat and not run efficiently, you make them more efficient. But to my mind, it's like using a nuclear weapon on something which doesn't deserve it. So private equity is not the way to go, at least in my book. But again, I am the value investor who want to make money with taking little risk, or as little as I can. Does this answer it? Yeah. Okay. Yes, sir.
I was wondering how you value the management team, especially in the tech area.
How do you value friends? How do you value a wife? How do you value classmates? I mean, again, it sounds flip, but human beings are inherently programmed to make good decisions on other people. It's a trait that let us survive. You talk to the management and you ask them a question. You ask them, who are your clients? What do you do? What's your plan? What do you think? They try to see if they answer you correctly. They try to see if they try to talk all the time or let you ask questions. Do you have what I call organization behavior or practical group dynamics in school here? Okay. The first thing to know in group dynamics is the way they behave here is the way they behave outside. If people tell you don't let anybody talk in this place, you over-talk over all of us, you say, but I don't do it outside. Yes, you do. So the way they interact with you is the way they interact with client, the way they interact with each other. Here is the way they interact with each other in the boardroom. So you sit there and you interact. And the way I do it is my own idiosyncrasy. I just let them talk and I ask them, and when I come out, I do a brain dump. I write everything down that I thought, everything. And then I and my partner or other people sit down and compare notes. But the human side of the interaction is extremely important, and it can be quantified. It can be more than quantified. There's two books book for therapists, that is called The Structure of Magic by Grinder and Bandler. And it almost sounds like Dickinson characters, but true people from Santa Cruz. And they show how language works and how you can interact to understand what people are saying and how they're saying it. But to evaluate people and people effectiveness is a human resources function, but any CEO worth his or her salt, I mean, that's what they do all day long. So when you are an investor, the first thing that I always remind my analysts, my partner, other people, is that don't try to superimpose your judgment on them. Try to see what they are saying, and over time, to see if it works. But I give you a fuzzy answer, but the structure methodology of how do you evaluate management, my book goes into it. You go into motivation of each one of them, both collectively and separately, and how the group motivation works. There are ways of doing it. Over time, as you do it, you're going to get better and better, so long as you know it's important. Does this answer the question?
Great, thank you.
Okay. Yep.
I'm curious about how you do all this like research. Like, do you have analysts who really form a street team? It doesn't really matter if they're an MBA or they're CFA, but what really matters are their interpersonal skills, and, like their skills of reading people. And if so, like when you're hiring someone, do you care more about their skills at detecting human behavior than at their academic skills, MBA or CFA? And do you yourself go out and go to the courthouse and talk to Gladys, or do you have analysts who do this? I'm curious how it really works.
Well, I ran 3 research departments, and the analyst we have right now, Irving Ho, he is my 49th or 50th, forget. And it's difficult. The one thing I always look at in analysts, they have had one creative endeavor. When I was at Gordon, we used to hire people who are either musicians or mathematicians, but high-level math is almost like an art. I had an analyst, Betty Yip, who was a very good piano player. Stephen Lee was a high-level chess player, and Irving now is, he's playing poker at very high level. The previous guy had also very high-level poker playing level. You have to be able to see patterns that interact with people in patterns. And it's something that you can develop, but you have to like it. People who do only numbers and screens and academic formulas are people who don't like other people, and they try to put something between them and the world. Sort of they are geeks in the sense that they're playing video games rather than playing life. You want those who like to play life. And once you do it, then you begin to feel it. I always said an analyst of mine should be able to land in Hong Kong, and in about a week he has a smattering of the language, he has a girlfriend he has to go to and a party to go to, and who knows going in town. But why would a guy like this work for me? He can do it for himself. You want somebody who can land on his or her feet and like the interaction with the real world, because investment, in effect, is people doing things with other people. It's almost a pretext. Investment and business is a pretext for people to go out and be with others. Women can go with each other just to have coffee and talk. Men sometimes don't do it. They need to have golf balls to kind of talk on the side to what really goes on, to have something to do in the meantime. In the office, you talk, there's business, there's this, there's evaluation. You have to like to be with people. And when you are with them and they feel it, they open up to you and you learn stuff and you keep your mouth shut and you buy and sell. I have some criteria how we hire people and how we evaluate management. And they change all the time because everybody's different. Does this answer it?
Yeah, it does. I'm just curious. Do you actually go there as this research on the street?
Oh, sure. Oh, sure. You have to go out there and, I go to California every now and then and just go and talk to people. I talk to people at elevators. If I go in the elevator in the building and there are some 3 pretty girls standing behind, I go and say, which one will come in? Guess. And there's a betting going on immediately. And if they got the elevator right, I tell her that, you're good for the stock market. And if not, well, today you didn't, but we do it every day. Over time, you develop the knack of talking to people, but you have to like it. If you don't like it, don't do it. And if you do it in companies, you always form contact with people in the company itself. You can call them later on a personal level and ask, how is it going? Every company you go to, meet as many as you can. Not business cards. Stop by the way. You know, somebody's on the machine. Oh, I see your hat. Are you a Dodgers fan? My uncle used to play for them. Remember the game in '67? Before you know it, you have a buddy, you call. Not rocket science.
Thanks a lot.
Sure. Yes, sir.
Two quick questions. Because we are so good in technology, do you identify a technology which can be the future, say, e-commerce, and then try to find a stock which is undervalued in the technology? Or you do a reverse where you find an undervalued stock and see if the technology can become the future? And second question, like management team, if you feel like through all your analysis and whatnot, patterns and all, that it is very good. We have discussed in like our class also. Can it be sustainable? Like what if the management team goes, say for example, Steve Jobs, if the innovation stops, then what will happen to the stock?
Okay. Again, the questions are good. First question, do you first of all try to identify where the future is going and ride it, or you just buy things cheap? Do you go for the bride or for the dowry? You can see, I'm not PC. We usually first of all like for some, say you look for the horse or the betting on the horse. We usually like to buy things cheaply. So the first screens we run, the first thing we look at, is it cheap? Because otherwise, we have to make what they call the heroic assumption. You have to say the stock today is 10. The highest it ever been was 10.5. It came from 2, but it's worth 100. The assumption you have to make is going to make money more than it ever did before. They're going to do fantastic things for the first time. Maybe it will. It's a heroic assumption. You don't like to make them. We let other people, growth investors, do it. There are plenty out there who should, God bless them, go make the money. So forecasting the future is something in which I sell the clients my brain forecasting power. It's okay, but it's a pretty slim reed to hang on. So we try not to do that. Saying that, every now and then we do find obvious trends. We invested in some parallel processing chips that have done things for the face of a phone, and we made money on it. But it came almost by hazard on the side. It's not what we do. We start usually by cheapness, and if it's all very cheap, then you look for the best horse at the best odds. But start, first of all, it has to be cheap, because we try not to lose money. That's the first thing. The second question was about management team. Some management team are more suitable for one business than the other. You can have a fantastic management that likes to grow very fast, but if this business needs an incubation period of 2 years, this guy or girl is going to wreck it by being impatient. On the other hand, if you have a business that has to start growing and have a cautious person running it, again, it won't work. But all this comes out to discussion with people and seeing what they do. But there are some people who are just good in everything, not many. And there are some who are good in nothing. Warren Buffett said that the best manager in the world, when he runs a bad business, won't help him. The business will win. Okay?
We talked a lot about looking at and how you make up the decision, how you make decisions to buy stocks. I'd like to know how you make decisions to sell.
I hope nobody would ask. I hope nobody would ask. It's one of the most difficult decisions to sell. About a year ago, I went to my friends of mine. I mean, money managers, they are competitors in Canada, but by the way, in Canada, some of the best money managers in the world. They're honest, they're good, they're nice, they talk to each other, wonderful. I mean, I wouldn't be any other place. I asked them, how do you sell? And they all did, you have to ask. It's difficult. Sometimes you sell because it reached the target price. But we have been in Novatel GPS in Alberta. The stock was about $1.50 to $1.80 to $1.20. It took 9 months to accumulate. We knew it was a baby gorilla. They had the best GPS chip in the world, which came out of a $500 million misspent by the local government. They left a shadow value behind. The good, honest people ran it. We bought and bought and bought and bought and bought and bought. And then it went over about 3 or 4 years to maybe $12. Dennis Trimble left his own company and joined the board, and he joined, bought some more. It went to 12, 13, we said enough, we sold it. Jerry Schwartz bought it. Onyx. It went to 50. They sold. It went to 15. I should have bought some more. I was so heartbroken. I couldn't see straight. I didn't buy. Stupid twice. When do you sell? We did okay. You know, when you get your pride get wounded, you rub it with money. It's okay. But the sell decision in slightly less frivolous, only slightly less, is that when the stock isn't worth it anymore, you sell it, you buy something else. There's always more things to buy. When the main reason for which you bought the stock, they blew it, you sell. If the stock all of a sudden traded 3 times the float at units of 3,000 each, you had a crowd of eager beaver day traders who know more than you do, or they think they do. It's social justice to give it to them. Al Gore would approve. So all these things are the easier one. But if you bought something at 2, and now it's at 6, at 2 it was maybe 3 times EBITDA, and at 6 it's 1.5 times EBITDA, it'd be foolish to sell, unless they have a lawsuit or whatever. So you have to reevaluate the cheaper all the time. Sometimes it's obvious, sometimes it's not. But the sell decision, I would say about 30% of the time is risk control, that you know half will be wrong, but the other half will save your butt. It's the most difficult one. But at least it's pleasant to sell when you make some profit and you put the money to something else. But it is hard. It's a good question. We like to be 3 or 4 or 5 years, but sometimes it's, I mean, the one we just sold, the V-chip company, it was about, I think, maybe 6 months, because we bought it, we thought it's going to take about a year before the value will be discovered. This one went out fast. I would say on the average can be between 1 year to 3 years, and some of them very fast. The mistakes we kick out fast. There are mistakes too. And we try to make it longer because we try to generate capital gains. But at the same time, if it's only a regular gain because the value has been discovered, we don't mind. So the answer is we had a bias towards longer holding period because it's a good business to work once and get long returns. It's like doing R&D. You do R&D once and you get product for 3 years. If you're in the service business, you get billed for an hour, you spend an hour. So we try to get it longer, but it sometimes depends on us and sometimes not. So we like to buy things cheaply. By definition, you have to wait before the value is discovered. So between 1 and 3 years, some of them less. Okay? You've been very patient. I have to commend you. Nobody fell asleep as far as I could see.